Welcome to the flagship market observations call for the week of December the 19th. Just a reminder, this replay is for advisory use only. Going to start by recapping last week. S&P traded down over 2%, now in the red 5% for the month of December, 19% on the year. Headlines last week, FOMC raised Fed funds by an additional 50 basis points. That was widely expected. Obviously, that is a little reprieve from the 75 we've received as of late. However, release of their dot plot suggested the median terminal rate would be higher than previously forecasted. A range of 5.25 is now the median, as opposed to 4 to 4.75 that we got back in September. Also saw 7 of the 10 members expect the terminal rate to be higher than current projections. That hawkish tone obviously weighed on markets further, or in addition to Powell's comments, suggested still have plenty of work to do on inflation, and they would stay the course until the job was done. On that point, though, I think going forward, it's less about Powell's rhetoric, more about the actual data. If we go back to this time last year, Powell hinted Fed funds would increase by 100 basis points. Here we are, 450 later. Obviously, he had to pivot in response to what was historically higher and stickier inflation data we digested throughout the course of the year. Now, that said, inflation is certainly trending in the right direction. As we've talked about, though, the question is, what is the acceptable pace? What is the acceptable level of inflation where the Fed can ultimately back off? And as a result, I think you've really seen the narrative within Wall Street start to shift, moving away from inflationary concerns now to more growth, with the majority in the camp that earnings estimates for the S&P at 5% are still too high. Interestingly enough, that is in very sharp contrast to the sell side, whose consensus forecast for the S&P to end next year is at 4,500, a substantial double-digit gain from where we are today. Ultimately, I think the focus as we get into the first few quarters of next year is going to be what falls faster, inflation or growth. If it's the former, then the Fed can back off. That gets us into that soft landing scenario. If it's the latter, do think very good probability those equity puts are going to be trading in the money. From a positioning standpoint, few trades to announce this week in the strategic portfolios, specifically within the bond allocation. We've taken some gains in more credit-sensitive instruments, taken now a more balanced ag-like approach. Not to suggest that interest rates couldn't tick a little higher here. Ultimately, though, that was just a reflection of what we view to be the bigger risk towards bonds going forward. And at this point, that would be credit versus duration, obviously a 180 from where we were at the beginning of this year. From an implementation standpoint, one thing to think about would be preferreds. Within investment grade, that is obviously a very high quality asset class, one that also offers a fairly attractive yield north of 6%. For more ambitious folks, may consider emerging market debt. We haven't necessarily bought that in the models, but that's an asset class yielding in the mid sevens, and obviously one that does benefit from a falling dollar, a trend that we do expect to continue. Granted, though, for folks that continue to play it safe, JPST, the JP Morgan Ultra Short Bond ETF, still one we continue to own in the tactical models. Yields just shy of 4.5%, have virtually no duration or credit risk. Again, silver lining of rates ticking higher as cash is now a much more attractive asset class versus what it was, let's say, 12 months ago. The equity side do still have a preference for value over growth, specifically like dividends. For a more contrarian idea, small caps from a fundamental standpoint do look very attractive. Again, we're talking about 5% earnings growth for the large caps likely being too high. We're seeing earnings estimates for small caps increasing from their already mid double-digit ranges. Recent estimate went from 13 to 14%. Also, they remain incredibly cheap, both on an absolute basis, but especially on a relative basis relative to large caps. Again, now may not necessarily be the best entry point, but absolutely something to have on your radar, have on your shopping list when we do ultimately come out of whatever recession may come ahead. Turning to the week ahead, fairly quiet week. Expect trading volumes to be low. I think that is a function of the number of out of offices that will likely be up coming into the holiday season here. Friday, we do get some inflation data, inflation expectation data. Obviously, keep an eye on that as we continue to frame out the narrative there. But ultimately, don't expect a ton of volatility up or down. And then in other news, congratulations to Argentina for winning the World Cup. Very exciting game Sunday morning for those that take place in football. Very interesting story. Elon Musk publishing a poll rather, asking if he should step down as the CEO of Twitter. Early indications suggest or voted in favor of that. Not surprisingly, you saw Tesla shares rally in response. And then internationally, China obviously been a country remained in the headlines as of late. We saw a pivot there with the reopening. Not surprisingly, saw a surge in COVID cases over the last several weeks. Several million have been reported. Interestingly enough, though, of those several million COVID cases, only 2 reported fatalities. Kudos, obviously, to China and their medical staff, which granted is widely viewed as being undersupplied. I think if you believe only 2 deaths for the million of reports, should talk to you about a bridge that is for sale. That is all for now. As always, have a great rest of the week. If we don't connect, have a great holiday. Take care.